Smart money gets taught as an endless glossary, 40+ acronyms, no idea which one to trust when price is live. This masterclass filters it down to 6 mechanics that describe the same market truth from different angles. Here's the map. 6 core concepts: the non-failure swing, anchored VWAP, liquidity inducement, stacked imbalance, point of control, and the range quarter zone. Concept 1, the non-failure swing, the strongest structural tell of a trend reversal, also called the market structure shift. A lower low, then a violent higher high. In a downtrend, price prints a lower high and lower low. Then a higher high closes above the last swing high. Structure flips. The break is the signal, not the entry. Mark the level and wait. Enter on the pullback, not the breakout. After the shift, wait for a retracement into the impulse leg. The 61.8% golden pocket is the most watched level, and price often gives you a couple of chances there. Concept 2, anchored VWAP, one line that prints where a pullback ends by anchoring the average to highs or lows. Change the source, catch the turn. Anchor on the prominent high with source set to highs. When price returns to the line and reacts, the pullback is finished. The same line, respected again and again. Unlike a flat level, the anchored VWAP travels with the trend. Each clean rejection raises confidence the trend is still in control. Concept 3, liquidity inducement, a century-old Wyckoff trap, a deceptive break that grabs stops before resuming the real move. Sweep the stops, then resume. 3 equal lows build resting liquidity, a magnet for price. One candle sweeps below, closes back up, and the trend continues. Why the trap works: stops pool beyond obvious lows. The push-through triggers a cascade of orders. Large players quietly absorb that flow, and once liquidity is taken, price resumes in the original direction, often with force. Concept 4, stacked imbalance, order flow, the aggression behind the candle, read on a footprint chart. Aggression, level by level. A footprint chart reveals buy versus sell aggression, invisible on a normal candle. When 3 or more consecutive levels are imbalanced, that's asymmetric liquidity consumption price reacts to. A fair value gap is really a low-resolution imbalance. The gap you see on price is the shadow of the stacked imbalance hidden beneath it. Footprint data just tells you exactly where inside the gap the real aggression sat. Concept 5, point of control, the highest volume price in a move, an acceptance level the market keeps coming back to test. The pullback ends at the point of control. Plot a fixed-range volume profile on the impulse leg. Its highest volume level projects forward and often catches the very same pullback as the non-failure swing. Concept 6, the range quarter zone, the simplest supply and demand method. Divide the leg into quarters and trade the one nearest structure. Trade the top quarter, target the high. After a strong low forms a higher high, divide the rally into 4. Demand sites in the 75 to 100% quarter, and targeting the prior high builds in roughly a 1 to 3 reward. 6 lenses, 1 market truth. These aren't 6 unrelated tricks. A pullback ending on the point of control often prints the exact same structure shift as Concept 1, and the anchored VWAP confirms where any of these pullbacks should end. Your 6 concept edge, recapped: the market structure shift, anchored VWAP, liquidity inducement, stacked imbalance, point of control, and the range quarter zone. Cut through the noise. Focus on what actually matters. 6 mechanics, 1 market truth. Backtest them, stack them, and let confluence make the decision for you.